Welcome to the Gray Report. I'm your host, Griffin Haddad, and with Spencer Gray still on family vacation, I've got special guest and newest team member, Matt Sulkowski, our asset manager here at Gray Capital, in the hot seat under the bright lights to give you this week's episode of our podcast. This week, Matt and I will be jumping back into the jargon bin, discussing multifamily economic occupancy. We're also going to be jumping into apartment list renter migration report, taking a closer look at where people are moving to, where they're moving from. We're breaking it all down this week on the Gray Report. Thanks for being here. Let's get into it. Welcome back to the Gray Report. I'm your host, Griffin Haddad, and with me today in the podcast studio is Gray Capital's newest team member, our asset manager, Matt Sulkowski. We already start off the episode. Matt, how are you doing today?
I'm doing great. Thank you for the introduction, Griffin. Happy to be here, and especially happy to be one of the newest members of the Gray Capital team.
Absolutely. Matt has been on board here at Gray Capital for a month.
Just under a month.
Awesome. Time is flying. It seems like I've lost track of time just being busy. Like everybody else, but I was going to guess a month, and that would have been spot on.
You would have.
I think the team here has really appreciated your presence. We have, I think, a portfolio that's growing, and we had a large need for an asset manager that could kind of wrap his hands around our portfolio and lead it in the right direction. And we'll certainly get into your role and your daily task and your primary focus here at Gray Capital underneath our asset management umbrella. But I wanted to first just introduce you, let our viewers, our listeners, our LPs, prospective LPs, industry professionals kind of get to know you a little bit better before we take a look at what you're spending each and every day doing. So give us the elevator pitch on you, Matt. You know, what do you tell somebody when you're introducing them?
Yeah, absolutely. I'm originally from Southwest Chicago, grew up about 15 miles west of the city, lived downtown most of my professional career, and just moved to Indianapolis suburbs about 5 years ago.
Sweet.
It's been a great transition. I have two young boys and couldn't think of a better place to raise a family here.
Chicago to Indy, that seems like it's a similar path I think a lot of people are following. Have you found, talking about multifamily and rental rates, have you found the affordability here in Indianapolis to be noteworthy?
Oh, it's incredibly different than Chicago. With real estate taxes in particular, probably a tenth.
Wow.
It is. My small condo in the city that was $300,000 had the same taxes as a $2 million house here in Westfield.
It's unbelievable.
It's crazy.
Well, welcome to Indianapolis. Obviously, we're happy to have you here at Gray Capital. You say you have two boys.
Yep. Griffin, wonderful name.
There you go.
And William, 4
I didn't know
and 6.
This is brand new information.
Yeah, my youngest.
Awesome. That's
Same
fantastic. I have met one Griffin in my life that's been older than me. And so I'm 33. But I run into Griffins that are, anywhere from newborn to 12 years old, 15 years old all the time. It used to be when I was growing up, I could go to the park, and if anybody was yelling Griffin, it was my mom, and she was mad at me. Nowadays, I can go to the park, don't go to the park very often, but if I'm in public, there's always some mom yelling Griffin, and I'm like, who, excuse me? You're not talking to me.
Yeah, don't hang out at parks if you don't have kids.
Well, very cool. It's awesome that, yeah, exactly. It's something I shouldn't do. But I do I have a dog. We walk our dog. Outside of the kids, obviously your time is probably a little bit tightened and constrained with two kids running around. But what do you do outside of work? What's your interest? I know we've talked about snowboarding and golf. Is there anything outside of those?
Yeah, obviously I like to hang out with the family. We do all kinds of activities. I like to be outside as much as we can.
Sure.
Going to the parks, doing things of that nature. But certainly golf eats up a lot of my summer and my free time when I can get away from the kids and work.
Yeah.
And then vacation-wise, going to the beach and or prefer the skiing. So I do like going out west at least once a year.
Right.
It has been a minute since I've had little kids. Not easy to get them out on the slopes just yet. They got to get a little bit older, but very shortly we should be doing a family vacation out there.
That's awesome. To have access to, or the skill set to go and have access to the mountains, to then introduce your kids to, I'm sure that will be a really fun and exciting thing for you and your family to do here in the near future.
Absolutely.
We talk about golf in the office, I would say almost daily, just because it's such a shared medium of interest between myself, you, other members. But what we don't talk about is snowboarding or skiing. And I know you said skiing, but I'm aware that you're more of a snowboarder.
I do say skiing as a generalization. I do snowboard.
Okay.
I can ski, but I'm much better at snowboarding.
Okay. And then, we're here in the Midwest. You said you moved from Chicago. We've got two places in Indiana that I can think of, Paoli Peaks and perfect north, but then you go up in Michigan, you can get up there quite a ways. There's several, I would say, good ski resorts up in that direction. How do you, outside of that big ticket trip, lift tickets, ski passes, mountain passes, whatever you call that, are you accessing some of these Midwest ski resorts, or you pass on all those?
I am a little picky, and no, I have not been to the local Midwest ski resorts mostly. I did go to Paoli Peaks, I believe, when I was at IU and down in Bloomington. I think we did go on a snow day, made a trip out there. So I have been once, but it's been a long time.
It's it's a little bit less bang for your buck, I would say. It's a mundane, and you go there for a couple hours and boredom kicks in. So don't blame you.
We'll definitely go to train the kids, and we'll practice there before I take them out on the big slopes. So it's in my near future, just hasn't happened just yet.
That makes a lot of sense. Let's tailor it more towards your career. You just mentioned you went to IU for undergrad.
Correct. I was a accounting finance major down in Bloomington. Absolutely loved it. Wouldn't have changed it for anything before moving back to Chicago.
Awesome. You guys are national champions this year. I'm going to let you enjoy that. That's why I said that. I got to just announce it for the world.
Yeah. It's not so much in basketball this year, but we'll take the big win in football.
That's a big one. After IU, moved up to Chicago. Walk me through your career path. I've got it in my notes. You were at PwC. You're a small business owner, operator. Moved back to Indiana, and now you're at Great Capital. Kind of fill that void for me in between leaving Indiana, specifically Bloomington, going back up to Chicago. You're a certified public accountant. You also are a small business owner. So give us kind of a brief rundown of that transition period between graduating college, initial career path, to kind of where you are today. I know it's a longer time window to summarize, but do your best.
Yeah, absolutely. So I started my career with PwC in Chicago, mainly focused on real estate. Did a little bit of structured products work, but a lot of lease audit, a lot of valuation for financial reporting, bankruptcies, things of that nature for a bunch of the Fortune 500 type companies to just make sure their valuations were correct in their books. After PwC, I did go to Lone Star Funds and Hudson Advisors, where it's a large private equity fund that I focused on acquisitions. So I did a little over $1 billion in multifamily acquisitions with them, as well as other asset classes like hotels and office and a lot of industrial actually as well.
Okay.
After that, I did start my own business in the cannabis industry for a while. So I ended up creating a business plan, raising about $8 million in equity and another like $10 million in debt.
Wow.
Ended up developing a large-scale production and processing facility, as well as were awarded a few different dispensaries, and was able to fund all those, get it developed. I GC'd the projects. Developed it all, ended up having about 60 employees working for me, and operated that business for about, from the start of it, 9 years.
Wow.
So
9 years.
It was a long time, but it was a great, well-rounded experience. I was originally a CPA, then I ended up getting my CFA charter. That helped kind of give me a lot of the education and skill set that I needed to go out and actually create a fund and raise the money, work with the investors, have the confidence to go out and actually develop and come up with the real estate, and then obviously manage the business itself and all the people, which is probably the hardest part.
Yeah, the managing the people, I've got no doubt, is the most difficult part. I think with all that said, your past career track record has really given you a very well-rounded, diversified vantage point of commercial real estate, specifically how it applies to multifamily. And I know running a business, taking a look at the financials, the profit and loss statements, all of that kind of comes together in culmination to now being the asset manager here at Great Capital. We've got a portfolio of, I believe it's 12 individual assets currently, with a fund vehicle that is capitalized or diversified across 4 of the assets. So we do have a lot going on. It's I would say, large-scale portfolio of near $1 billion. It seems like you're able to take that seat at the asset manager desk here at Great Capital fairly seamlessly. I wonder what part of your past career trajectory is kind of maybe afforded you the most comfort in accepting and fulfilling this new role here at Great Capital. Was it starting your own business? Was it being a part of the PwC? Was it the real estate development? Is there a single point that you can kind of select or highlight?
I'd say it's twofold. I'd say in my role within Hudson, where I was doing a lot of the underwriting and valuation for acquisitions, I had to create a lot of the business plans, which included full CapEx renovations of interior units at various levels based on the submarket and the demographics, where we bring in a B class up to an A or a C up to a B. So I had to create and come up with all those business plans, and then I would transition it to our asset manager who would actually go out and execute it. So for a long time, I was creating all these models and business plans and seeing how it impacts the actual purchase of the property and then eventually the sale. So now I'm just basically taking that same information that I was doing on the front end, and now I'm kind of helping manage and execute it on the back end. And then I would say within my entrepreneurial experience, you're basically a professional, drawing a blank on the word now, but problem solver.
Yeah, sure.
Every day,
Solution orientation.
every day you have a plan, and basically you get 1 hour to execute that plan because the other 10 hours are fire drills here and there, people problems, insurance problems, markets rapidly changing unexpectedly. In cannabis in particular, there's a lot of red tape. So I became very good at going with the flow and being able to put out fires on a daily basis. So I feel like in the asset management role, for now, I'm very much observing and still kind of getting my lay of the land of the portfolio, seeing how the operating on-site teams are communicating and corresponding with corporate, and trying to figure out how I can fill that void, provide time for Spencer and Jay to focus on more big picture strategy, new acquisitions, which hopefully we have a few more properties coming down the pipeline here, which it sounds like we've been having some luck of late. And then that way I can, help avoid some of the leakage and solve some of the problems. And I think with my unique background of both entrepreneurial as well as a lot of the investment or institutional real estate side, I bring a different view or perspective than, what a true property manager or asset manager may have brought into the company. So I'm excited about not only, fulfilling my role here as asset manager, but hopefully being able to add value, whether it's on the tax side or just overall management and operations side, communication, and more importantly, provide Spencer and everyone else here at the corporate office some time to focus on the big picture and the more value add and not as much in the weeds. And hopefully I can help focus on taking care of those problems for them.
The filling of the asset manager role here at Great Capital, I think, was a really exciting thing exciting development for basically every department, every chair in the building. When Spencer and Jay and Andrew and Alex were all conducting interviews for the asset manager job, I know it was pretty hotly contested because there were people coming in and out of our office door. Spencer had interview meetings on his calendar almost daily. And I know they gave you a case study for essentially a solution-oriented approach to one of our assets that we currently have in our portfolio. Walk me through the interview process here at Gray Capital, because I feel like we really put you through the ringer in the interview process. And there's kind of a twofold. You have to obviously be proficient and know what you're doing and be able to provide that solution-oriented approach that also Spencer and Jay and Alex and Andrew and Blake, they all share. But there's also a personality fit that I think comes into it that I think you've done a great job of satisfying thus far. But talking about the interview process and that case study, what was asked of you, and then maybe just a little bit on once you got offered the job at Great Capital, what was it about Great Capital that was interesting to you?
Yeah, absolutely. It was quite an in-depth interview process. It took, I believe I applied in early to mid-December, had my first phone screen with Jay mid to late December. Obviously with the holidays, there was a little lull there, and then I started here in the beginning of March. So it was a little over a 2-month process. Came in the office a couple times, probably 5 or so interviews, including a case study of our property down in Evansville, which was basically I took all of our underwriting and kind of deal data as well as a trailing 12 and assessed where our issues are, any potential solutions, what are we doing, what aren't we doing, based on the purchase and the underwriting, where and why are we underperforming based on what we had expected. I believe it was like 8 to 12 page report I put together based on everything. And all in all, I think it went pretty well. I think a lot of the items that I brought up, we either were implementing, had implemented, or were in the process of implementing. So I think it was good that they, were on top of a lot of it, and some things it just takes time to actually get in. and do that. But yeah, it was a very in-depth. I was glad they, took their time and really wanted to fill this role strategically and find the right person. I did have a, I guess, different and unique background given my pretty long tenure in entrepreneurship the last 8-9 years. But I do think it brought a different perspective and, to the company, and they liked that I could get the job done. I have a good head on my shoulders. I think one of my biggest assets is I have a steep learning curve. I can pick new things up, and within a short period of time, I can wrap my head around it and get the job done.
You mentioned it previously in the show. You're not just kind of another asset manager that comes up from the ranks of property management or some large firm. It's just kind of earned the badge. You've been well versed. You've kind of been worn down, given the opportunity to see this business from a perspective of several different businesses. So I think it was attractive to our executive team that made the decision ultimately to bring you on board. Was just, hey, great personality fit, but a very diversified background, very diversified skill set, different lens to kind of provide this solution orientation approach to our portfolio. And you had mentioned it earlier and just kind of said, stop the leakage. At the end of the day, our job here at Great Capital is, one, to source great multifamily investments and then offer them to our LPs. Secondary to that, or maybe even in parallel to that, is to operate these investments prudently, being stewards of investor capital, to obviously prioritize capital preservation up front, but then work towards cash flow and growth on the back end. And the asset manager chair, you're seeing almost weekly financial reports from some of these assets. It's a lot of data to skim through. I want to bring in and kind of tie in AI, because Spencer is really bullish on AI right now, and he's really been generous and provided us the platform to utilize. In your past career, obviously AI wasn't as robust or built out or available. You enter in Great Capital's front door, and all of a sudden, you're kind of hit with this big wave of use AI in basically everything that you do. How have you found maybe some of your past practices in asset management, whether it's Excel or report digesting? How have you found AI to be helpful? And how do you think AI moving forward will ultimately help you in the asset manager role, help drive investor returns across our portfolio? It's a wide range of question, but good luck.
Thanks. Yeah, no, AI was definitely not a big, part or even any part of my role back at Hudson or PwC. So I lived in Excel 60, 80 hours a week, creating models, building out, full portfolio, property by property, level financials to roll up into a bid to buy the portfolio. So a lot of my time was spent, in the weeds in Excel, where it was great because it, taught you all the ins and outs and how to do it. But now with Claude and AI, a lot of that tedious continual work can be done, and now it's just more auditing and making sure that it was done correctly.
Right.
So it does definitely save time. I think one of the biggest parts is more on reviewing like loan documents and insurance. Like we just recently redid all of our insurance to more of a portfolio umbrella. And it can just help digest that, or current lawsuits that we're working on a FHA case that was with our developer. It can easily digest a 100-page lawsuit into more digestible bullets, so that I didn't waste a morning reading 100 pages of information that I probably only needed 5 pages worth out of it. So there's definitely been a lot. I'm certainly still getting used to the whole AI being a part of daily life, as I'm sure everyone is. I'm very excited to see how much more we can continue to use it, and it can continue to make my day more efficient. But it's an incredibly powerful tool, and I hope I get to the level that Spencer's at one day, because man, he's pretty incredible with the things he's able to do with his AI. So
he sure is. It's exciting. It's also a little bit overwhelming, and I say that because there's a lot coming at us all at once, drinking from the fire hose, and it's been really awesome to see the growth of AI and how it's getting utilized across our teams. And then Spencer will go home on his own time and he calls it vibe coding. He'll produce something overnight that's absolutely mesmerizing and phenomenally fantastic for lead generation or transparency into Great Capital's operations. And I'm like, man, I'm so behind. But I think he's just got this really very individualized vision for his company, and he's able to think of, imagine, and then create these dashboards or products that otherwise he would want as an LP, or he would want as an asset manager, or maybe that he would want as a property manager. And so it's maybe not easier for him to create these things, but he's got that autonomy and that personal freedom because he is the CEO of the company to go out and create something, for our entire team to use. But it is a little intimidating. I'm trying to, find ways to incorporate it in my daily workflow, but it seemingly requires a little bit more time and input on my morning to get the day started. So I'm slowly wading into the AI scene, but it's awesome. It's pretty cool.
Yeah, I mean, it definitely helps with creating, pitch decks or
unbelievable.
Anything of that, like formatting. I mean, Spencer's creating whole tools, and
right.
He's on a different level.
Right. I had some buddies text me the other day. They are one of them works at a Big Four accounting firm. He does a large asset sales. So when the Denver Broncos get sold, he's out there valuing that. And then got another buddy that is the chief investment officer, chemical manufacturer down in Tennessee, and they're all texting back, "Hey, do you guys use Claude?" And I'm like, "Dude, do we use Claude?" Absolutely, we use Claude. I am Claude at this point. So it's funny because I feel like I'm a little bit behind because Spencer is so prolific. But I think relative to the the masses here at Gray Capital, we're definitely ahead of the curve. Just curious, you've been here for a month. You've really been investigating our portfolio. Obviously, when you start a new job, you're excited about it. You get into the job and maybe the excitement is stagnant, it maybe grows or shrinks. Just curious as to what your first month under the hood of Gray Capital and our portfolio has done. Would hope that you're still excited to be here. We're on a public podcast. If you say otherwise, we're both in trouble. But I just want to know about the first month here at Gray Capital, the team, the portfolio, and where you see this company going, because we are kind of like exiting the startup phase. We're growing and we're scaling it at a pretty fast rate because we do have such an immense capacity for growth, and you're a big part of that growth. And so being here for a month, looking at our property, our portfolio, our teams, our communications, obviously we're excited to have you. We hope you're excited to be here. Where do you see, kind of the next month going as you get more settled, more comfortable, and able to kind of be a little bit more effective and efficient?
Yeah, absolutely. Well, I definitely, chose the role here with Gray Capital because I love the culture. I love that it is, a more, not startup, but smaller company with rapid growth aspirations and goals. Clearly, that's where I wanted to be. I wanted to be with a smaller group where I can go in, roll up my sleeves, obviously get my work done, but add value where I can, and help to see that grow. And I certainly think that that's happening here. And my first month has been great.
Good.
Definitely getting the lay of the land. Going out and seeing all the properties. We do have a wide variety of properties. Some more working class, and some others A+. Doctors and everything else in between. So it's been really great to get to know the team. I've been focused a lot on the maintenance and some of the more operating side of things, because I do think maintenance kind of drives a lot of our asset performance as well as tenant utility, and our ability to turn units, get preventative maintenance done, answer tickets, leads to higher renewals, which leads to increased rent growth, which leads to all other, great things. So a lot of my first month has been focused on CapEx and kind of getting to know a lot of our maintenance, correspondence, how we're communicating, how we're getting things done, which has been a big change of late here because we went from more of a property by property to a very centralized here at corporate role for both leasing, management, and maintenance. And that all changes are hard and take time, and especially when working with people, no one likes change. So that has definitely been some growing pains that I've gotten to observe and see how I can help add some communication, clarity, standard operating procedures, and such. So I think it's all great, and I think we're all going in the right direction. But I think I could be a really important middle person between all the staff at the on-site and their ability to have their communication, their say here at corporate, because sometimes that there's a little disconnect.
Sure.
And I think I could be a good resource for everyone and hopefully avoid turnover in the future at the leasing, property manager, maintenance side of things, and just continue to assess our properties and find where we can add value.
Yeah, you've been driving the properties. I think you were up in South Bend. Was that last week? You're getting ready to go down to Bloomington tomorrow. Been out to Terre Haute just yet?
Not yet.
Okay.
Not yet.
We should start buying properties a lot closer together so you don't have to drive so dang far to go see all the properties. But it's an exciting thing to go see the portfolio and become familiar with, obviously, the on-site staff. They're going to be communicating with you and some of our centralized care team here on the gray residential side. And so I think it's an awesome thing that, one, you're familiarizing yourself with the asset, the market, but also the on-site team. When I first got on board here at Gray Capital, I tried to do the exact same thing, but was fairly daunted by the distance between a few of the properties. So I just would tag on with essentially Joe before Joe was Joe, and would drive up there with him, knock out some maintenance orders, work orders, take care of some business, and just kind of lend a hand where I could and see the property. So I think it's an invaluable thing to be able to go up there and get boots on the ground to then go and be able to implement your strategies and be effective or most effective and communicate with the staff, but also making sure that the asset's being managed appropriately for our investors.
Yeah, absolutely. And you got to go and see everything that you're working on. And I've enjoyed. Right. I don't mind a little road time. And Villas was great, beautiful property.
Oh yeah.
Hopefully, we may be looking at a refinance later in the year, so it's something I'm definitely kind of a little bit more focused on to make sure our occupancy and everything's buttoned up on the property side of things there. So, yeah, it's been a great one. I was at Solana a couple weeks ago too, which I think will dovetail well into our economic occupancy discussion later.
Cool.
Because I think that's basically a perfect case study for that kind of communication. So, we could save that for the next step. But
right. Let's do it. Let's jump right into the jargon bin for this week. Excited for this one. I picked this one out just because we got asset manager Matt underneath the lights here in the podcast studio. I want to talk about economic occupancy in the jargon bin this week, breaking it down at 3 tiers or depths of knowledge. I want to start out with just the novice definition of economic occupancy. We were talking to Jay, Chief Investment Officer here at Gray Capital, earlier today, about how he used to describe economic occupancy to his students when he was teaching. And he had this big diagram that he used to get out of, a house with 8 windows, and there'd be 7 of the windows with an individual sitting in the window, and that would indicate that unit was occupied physically for physical occupancy. And then, just next to that image of the people in the asset or in the windows, he would have a secondary image of the same people in the same windows, but with a dollar amount that they were paying in rent each month. And this helped him describe the economic occupancy in comparison to the physical occupancy of being, hey, this asset is 95% physically occupied, but there's 3 or 4 tenants that are paying less than market rent or less than effective rent in a few of these units. So we're not able to collect that full rent check or the expected gross potential rent for that asset. And so that would then impact the economic occupancy. So I'm going to get away from that example. I'm going to put the pressure on you. Novice investor, never heard of economic occupancy before. What's the best way to describe economic occupancy and how it relates to multifamily real estate?
Sure, and I think your example was great. So if you have a property and you have it 100% leased, and everyone's paying exactly what you wanted them to pay, market rent, they're paying on time every month, no one's late, then you would have at physical occupancy and economic occupancy would be the same. However, typically we're coming into properties where prior management was giving 1-2 months rent concession to try to occupy the space. Clearly you're not getting a full 12 months rent out of that tenant, and then when you roll them over the next year, you still may not get up to your desired 12 months rent because they're used to that 1 or 2 months concession. So obviously bad debt would be another big component that drives the difference between physical and economic occupancy. If tenants aren't paying on time or if they're not paying at all and we need to go as far as an eviction, that takes time. Turning units takes time. So there's not only just paying under market rent, but there's the issue of people not paying at all or paying a portion of their rent. And it's not like if you don't pay you're out the next day. So there's obviously components there, and I do think when it comes to kind of underwriting and our ability to manage properties, our goal is to close that gap of physical and economic occupancy. So often if we're underwriting buying a property and we see it's 8% vacant but economic occupancy is at 20% vacancy,
big red flag, big question mark there.
But a great opportunity for a good manager to come in, and yes, there might be a lot of deferred maintenance, there might be CapEx issues, there might be management and an overall stigma of the property within the local population because of prior management. But that could be an opportunity to add value and increase the NOI and the bottom line, which is obviously what we're here to do for our investors.
Yeah, you hit the nail on the head there. The most basic formula for economic occupancy is just the actually collected revenue, or the rent that you're able to collect, over the gross potential revenue, or essentially what the market rent would be across all of those units. And so, like we said, an asset could be 95% occupied, but you're only able to collect 88% of the economic occupancy. And so there's room for growth there to be able to close that gap, close that variance, to then make that asset more efficient and effective for our investors, impacting NOI and ultimately free cash flow for distributions. Let's go one layer deeper in regards to economic occupancy. And I think I'm just curious on, what are the most common leakage points in regards to economic occupancy? And Spencer and I, we do this every week. We start talking about a term and we introduce 4 or 5 new terms that we haven't done in the jargon bin just yet. And so we're going to probably discuss bad debt, concessions you've already mentioned, loss to lease we've not talked about in the jargon bin, but we can kind of go into some of those as we enter into this next layer of understanding what are the variables or aspects that would overall impact economic occupancy the most.
I would say probably the concessions and then the loss to lease. So basically the concept of market rent should be at $1,500 a unit, but maybe we're focused on physical occupancy as opposed to maintaining our rent per unit. And so we, for a short-term period, will accept rents at $1,250. And so that $250 variance between our market rent of $1,500 and $1,250, while it might not be a 1-month concession or defined as like a month free or a concession, that leasing below market rent is probably one of the largest drivers. So our ability to, and it's hard to get above market rent. So it is. Not many especially tenants are paying greater than market rent to offset those tenants that are below market rent, or maybe a tenant's been at your property for 8 years and you can't raise rent on them at the rate the market is raising rents, and it's been a good tenant and there's reasons to maintain them. They don't have any issues, they pay on time, we don't want to turn the unit, and there's already maybe we're at 92% occupancy and there's no need to kind of push someone out just because they're 5% below market. So I'd say those are 2 of the big ones. And then depending on what type of asset class, obviously bad debt can balloon and become problematic, not only from just delayed and not getting actually the rents paid, but then that does lead to potential evictions. And depending on which neighborhood or submarket you're in and the judge, evictions can take time, which again just balloons the bad debt and then the ability to turn the unit. And typically if a tenant's not paying rent, they may not be treating the unit as well, so it could lead to additional maintenance and costs for on the turn. So I'd say those are some of the larger ones. Obviously we don't try to have too many down units, but if you have model or a unit occupied by an employee or something of those lines, either at a discount or free, that would obviously add to that as well.
Do we have, and this is a genuine question, I don't know the answer here at Gray Capital, do we have I would say just a threshold for economic occupancy that otherwise is, sends us into high alert mode in regards to asset management? I'm looking at the notes here that we put together before the podcast. It says below 85% signals an operational issue or untapped value. On acquisition, we may love to see that, because then we can go in, recycle the rent roll, really kind of arbitrage or capitalize on that economic occupancy, or what in this point would be almost vacancy. What do we see in our portfolio? Obviously, people maybe are listening for the first time, or they've been listening for weeks, but our portfolio has been seeing what I would think is some elevated vacancy just due to supply issues. Or not supply issues, just supply coming to market. And so we've begun to see occupancy drop. We've also offered concessions at our properties. All of the revenue growth in Gray Capital portfolio right now, or at least the majority of it's coming from renewals. We're offering, reduction in rent, at least comparative to market. on new lease execution. So where do we start to get concerned in our portfolio in regards to economic occupancy? Is it at 85% economic occupancy that sends the lights flashing and kind of draws it to your attention, or is it a little bit higher or lower?
Yeah, I think it probably would start paying attention a little bit higher than that. 85 is when I'd say it really kind of would start flashing at us. We're trying to be at about 5 to 7% physical vacancy, and then we another 5% on top of that. So hopefully at like 12% would be my back of the napkin right now would be where we'd want to be, and anything beyond that, the lights are going to start flashing.
Genuinely an unfair question for me to ask you because there's a lot of other variables that go into it: debt service payments,
Sure.
Cash reserves, other things that could be of interest. Real quick, let's dive into it. The industry expert level of depth. The economic occupancy is something that obviously we're aware of on acquisitions, but how is Gray Capital thinking about economic occupancy as a portfolio level KPI going forward? Obviously, on the acquisition side, we're looking to capture some of that higher variance in our acquisitions or looking for hidden value. But in regards to our current portfolio, what kind of, solution orientation focus are you employing or deploying, or are we utilizing to kind of make sure that our portfolio economic occupancy is standard or increasing or improving?
Yeah, I think the ratio between physical and economic occupancy is a great KPI for our overall management. So Solana is a great example of all this. When we bought it, it was about 8.5% physically vacant. To date, on our I was trailing 12 at acquisition. Our current trailing 12 physical occupancy has not changed very much. However, economic occupancy was slightly below 80% at acquisition.
Wow.
And we've raised that to about 91.6%. So at a 5.5% cap rate, that drove about $8.5 million of value in that property alone. And we're only 18 months into it, and there's a lot of room to grow.
Right.
When I first started, and I'm just trying to observe, I heard just nothing but a lot of anecdotal headaches and complaints about Solana. And after touring the property, I was a bit confused because it's a beautiful property, great location, and institutional grade. It's got the right vintage, right property size, right location, submarket. Everything about it looks like it should be one of the gems of the portfolio, and yet every day I'm hearing maintenance and everyone else just complain about it. So as I dug into the financials a little bit more, I realized a lot of these issues were coming from prior management. They were more focused on just getting it physically occupied to sell. They weren't screening tenants, so led to a poor overall tenant experience due to maybe not the greatest neighbors, a lot of bad debt, a lot of evictions, people not taking care of units, which makes maintenance turns harder, a lot more maintenance requests, which leads to turnover, and the whole issue kind of keeps ballooning. Right. However, as we just saw in the economic occupancy improvement, it is a great value add opportunity from the acquisition to now. So yes, It's 18 to 24 months of a lot of work and getting the right tenants in, which allows us to bump rents, especially on renewals and everything else, and have an overall nicer facility, less turnover, higher renewal rates, and overall we'll have a nice exit on that property. So I think from an ROI perspective, it should be a home run, while the first couple years fixing all the headaches, deferred maintenance. It's going to take some CapEx and some time, but I think in the long run it should end up being a very good performer.
Yeah, we hope so. And one of the questions that I have on our sheet was, why should investors care about economic occupancy? And I think that it's an important metric to identify, especially on the entry to a project, of just that value that we've been able to unlock or create by recycling the rent roll, not just putting heads in beds, but putting qualified heads in beds, and then obviously removing bad debt or improving collections, generating more revenue, being able to collect that revenue. When you slap a cap rate on it, like you said, it creates a exponential value for that asset in a theoretical or proposed disposition. So I think the idea of an investor understanding economic occupancy becomes really important when we're acquiring an asset, but also at the disposition of, if you're selling an asset at a more inferior economic occupancy, you're less likely to get the overall value that you were hoping for, maybe at the start or the midterm of that whole period, versus a higher, more palatable or acceptable economic occupancy can then lead to a greater purchase price or disposition price, which then on the back end really pads the pockets of our investors. But also, that's at exit, but also in the middle of the whole period, it does result in more steady, robust cash flow, because obviously you're able to collect more of that revenue.
Yeah, absolutely. And, part of my role here as asset manager is to work on dispositions and or refinancing, like I mentioned, with villas. So it's a key benchmark for us to always keep an eye on. I mean, we're not going to try to bring a property to market regardless of the capital markets and if it's at a very low economic occupancy compared to what, where we think it should be. So I view that as kind of our goal as a good manager to keep economic occupancy high and to improve upon it. And I think that, will overall help the investors and increase the bottom line kind of across the board.
It's a question I get, or Blake and I get, I'd say quite routinely. Underperforming asset, maybe a sluggish asset, maybe an asset like Solana that gets off to a slow start, and they're always interested in, well, why aren't you guys position this thing for an exit? Why are we not looking at potentially selling this? It's a drag on overall performance, or it's not performing to what the expectation was. And the answer to that question is that, well, we position our assets in a way, and we're long-term holders, so 5 to 7, 7 to 10 years, and we're not looking to. We don't have a forced sale. We don't have a loan maturity coming up. If a cap rate's getting ready to expire, we're typically going to buy a new one. But there's very rarely a case, I think, that I can envision at great capital, just because the way that we finance and acquire assets, that we would be in the position of potentially having to sell an asset with a low economic occupancy. So we get questions all the time. So why aren't we preparing, this asset for sale? It's had a bad, 2 or 3 quarters in a row. And it's like, well, it's just, again, you said it at first when we started the podcast, time heals a lot of things. Give our team time to implement these changes, have a solution-oriented approach. We can then slowly start to chip away at solving some of these problems that would then otherwise result in elevated economic occupancy, and then also generate cash flow and back-end returns for our investors. So let's wrap up the jargon bin there. I've got one more thing I want to show you, Matt, this week. This is from last week's podcast. This is apartment list renter migration report for 2026. Just because you moved from Chicago to Indianapolis, I wanted to pull this up. And this is actually a really incredible, I would say, interactive dashboard that Apartment List has created. You can select any market that you want. Well, not even enough that you want any, secondary to primary market in the United States. We're going to focus on Indianapolis because that's where we're headquartered, but it essentially breaks you down the top 3 markets that people are moving from to move into Indianapolis, Chicago, with 13.4% of people moving out of Chicago.
So you're saying I'm not unique, huh?
You're not unique. You're not unique, New York. That's a big number in my opinion. 13.4% of people that move out of Chicago are coming to Indy. And, I think there is a seeking out of affordability, maybe more space and privacy that's occurring. And if you've been to Indianapolis and you drive up on the north side, I think you can see why people are moving here, but also why people continue to build all of these neighborhoods, build for rent, large-scale apartment complexes. We just can't stop building in Indiana, but we seemingly can't keep up with the population growth. So just curious what you think about I would say, the mass exodus of people from Chicago.
I'm not surprised at all. I mean, I am biased given I went to IU, so a lot of my friends, we all graduated and moved to Chicago. Very few still live in Chicago, just whether it's COVID and work from home or having kids and just me, going out to the suburbs or moving.
Yeah.
So I would have thought it actually would be more. And I wonder if that's 13.4% of people moving into Indianapolis is from Chicago. I'd be curious if you clicked Chicago and did outbound to see what percent are actually moving here, because I would think it's a lot. It's a great market from affordability and from family. Education in Chicago is not great.
Yeah.
School-wise, paying a ton to go to private schools. So from a family and affordability perspective, it's an absolute no-brainer.
So I guess this is a better way to look at this than I think I was misspeaking previously, but the top 3 destinations for people outbound leaving Chicago is Milwaukee at 6.1% and Indianapolis at 3.3%. Milwaukee's interesting to me. I think you can live on the south side of Milwaukee technically, but be almost closer to Chicago.
Yeah, Milwaukee's like not even an hour
Yeah.
from the city. I mean, they've increased the highways and everything else, so
They got a
you
rail
can get there
system,
really
too.
fast.
Yeah.
So it's essentially a suburb of Chicago, but
Right.
it comes with, big city, not big city, but more city amenities,
Right.
baseball team, things of that nature. So
But still
I'm
3
not
point-
surprised that it's number 2.
Yeah.
I guess I didn't think about Milwaukee, but I could have seen it being number 1.
Right.
But to beat out Florida and Texas is, that's a big number.
So I want to look at the outbound of Indianapolis as well. I thought this was interesting. You just previously mentioned Florida or some of these coastal markets, Houston, Dallas, Fort Worth, Austin, some of those major Sunbelt markets and southern markets that otherwise are really attractive to, young professionals, but also, the retirees or the snowbirds. And I think that when you take a look at the people that are outbound, leaving Indianapolis, they're staying, regionally relevant to Indianapolis with, the majority of people moving down to Louisville or Jefferson County, which Jefferson County is one of the fastest growing counties in the state of Indiana, just north of the Ohio River of Louisville. So it does make a lot of sense. There's a lot of growth still there, but you're able to kind of maintain your social circle or, potentially still keep the exact same job if you have kind of somewhat of a remote setup. And then Fort Wayne, again, Fort Wayne's about, 2 hours from Indy, maybe a little less, hour and 45 minutes.
Yeah, I'd say about that.
Just that regional proximity, and then Lexington actually is quite surprising to me, but I understand it. You get down in the Smoky Mountains, it's about a 6-hour drive from Indy, but still none of these, West Coast or Southern coastal markets are leading the charge from people leaving Indiana. It seems like if you're a Midwest family, you're looking to potentially stick around the Midwest. And I don't know if it's the affordability, the affordable, or just the more favorable school districts. You have a little bit of space, some privacy, and just the Midwest hospitality.
Good family values.
Right.
You can't get too far from your relatives and friends.
Right, correct. There's one more graph. Are there any other markets that you want to look at? Curious about? Doesn't have to be.
I mean, I think the 2 most important are Chicago and Indy right now. And
I agree.
I know Chicago's
Let's take
losing a ton of people compared to Indiana.
Let's take a look at Columbus, Ohio, just because it's one of the fastest growing markets in the Midwest. It's also one of the leading markets in Midwest multifamily in regards to rent. So these are people that are moving into Columbus, coming from Cleveland, Cincinnati, and then Chicago is on the list.
I will say everyone that I know that is originally from Columbus has moved back to Columbus.
Really? It's kind of
And
like
they all love
Indianapolis.
it,
Yeah.
too.
That's so we've got Addison, who works in our acquisitions team. He went to school in Columbus. He's an Ohio State alumni. He loves Columbus very similarly to, I think, a lot of people that either went to school there or from there. But he's also kind of still in that prime young adult age where he's kind of free to move about the cabin, as I'd say, and can go off and be that young adult in a very vibrant young adult city. I'm curious. We'll love to talk to him maybe a little bit about Columbus versus Indy because they seem very similar. It's a Midwest metropolitan area with sports, walkability, and great summertime weather. Indianapolis to me, and it's funny because I have friends that went off to college to really awesome places, USC, whether you're going to University of Miami, all of these very awesome places that otherwise I think would be a little bit more favorable to live just because the weather's great and there's more exciting things going on. But everybody moves back to Indianapolis. It's family. And then again, I think the Midwest is just a great place to start a family and raise some kids to instill them in the values.
I will say the weather is significantly better than Chicago. I mean, even though it's only a few hours south, it's very material being away from the lake. And one other funny thing on the whole Indiana and Columbus situation is I did have a number of friends that went to IU with me from Columbus. Mm-hmm. And even though we won the national title this year, all of them were still rooting for Ohio State.
Really?
Even though they didn't go to Ohio State.
But
because they're Columbus and they're historic, diehard Ohio State fans.
Loyalty.
They would go to the game, IU versus Ohio State, still rooting for Ohio State.
Unbelievable.
I couldn't believe it.
Well, they ended up on the wrong side of it this year.
Yeah.
They did. This is the last chart we're going to look at, and we're not going to look at it for too long, but this is just net domestic migration in the United States from 24 to 25, and we're looking specifically at percent population change. Currently, red is a net negative population change, and green is a net positive population change. Idaho and South Carolina look to be leading U.S. net migration or population change from the last 2024 to 2025. It's good to see Indiana in a very light shade of green. We do have, I think, almost 0.2% population growth here in Indiana. Just curious as to what your thoughts are on this map. You know, obviously we operate in Indiana, Michigan, and Ohio. Michigan seems to be flat, if not maybe a little bit negative. I've seen some statistics of folks moving out of the Detroit area, and then Ohio, again, seems like it's a very light shade of green. We choose our markets because we're experts in these markets and we live here in our backyard. But it's also great to see that we're growing, and not only just economic growth, but also population growth. And then obviously with that, hopefully we're able to meet the housing demand for some of this in-migration. But Illinois red, California red, New York red. You know, I think there's some reasons behind all of that. And I just don't think we're going to see those reasons in Indiana, Ohio.
I'd be curious to see the 2020 to 2025 data as well, just because I feel like Indiana probably would do even better over the last few years as opposed to just last year. And I think compared to the nation as a whole, our affordability versus the jobs and income here is probably one of the best ratios in the nation as it pertains to rents. You know, the average rent or home compared to income in California, you know, is probably a third of ours, you know, or something crazy.
Somewhere crazy and close to that, I would imagine. Every week, Spencer and I are in here talking about the latest data and trends, you know, across commercial real estate, but with a very specified focus on Midwest multifamily. Week after week after week after week, we talk about how the Midwest is steadily leading the charge in overall population and housing demand. And why would you not invest in Midwest multifamily? We're here. We operate in the markets that we're experts in. They're in our backyard. We're born and raised here. We live here. We know these markets better than anybody else. We still have investors that come to us and they're like, hey, I want to invest in a property in Dallas. And that's okay with us. We don't mind that at all. But when you take a look at the population chart, you obviously know our portfolio. You understand the forward trajectory of Gray Capital, the fundamentals in the Midwest. And we had Carl Whitaker, chief economist of RealPage, in the seat you're sitting in last week, that said the exact same bullish sentiments on the Midwest in regards to multifamily investments. It just makes so much sense to be allocating your funds to Midwest multifamily. You obviously probably didn't think too much about Midwest multifamily, let's just call it 6 months ago. It's kind of consumed your world now. Without maybe being as familiar with the data as Spencer and potentially myself, what's your forward-looking trajectory for Midwest multifamily, specifically on the LP side, if you're going to allocate to the asset class? And you don't need to pump Gray Capital. You don't need to pump our book. Yeah. But it's just really hard to sit here week after week and see the data and see the bullish sentiment and have people want to start allocating back into the Sun Belt again. And I'm just curious, after being kind of engulfed in the Midwest multifamily ecosystem environment, living and breathing it for the last month, what are your thoughts?
Yeah, I think from a macroeconomics, I mean, everyone knows Illinois is in shambles. Indiana has a great balanced budget. So from not only the taxes and everything else, but I think we'll continue to see population growth and people moving here for the jobs. And I think that relationship that I was mentioning earlier about your overall take-home pay compared to your household costs. Yeah. Indiana is, if not the best, it's in the top, few out of all the states. And I think that alone gives us a lot of potential to bump rents, just because the people can actually withstand paying a little bit more. It's not like if they go up $50, they're going to be on the street, which is obviously good for us. Mm-hmm. So I think from a overall tenant renewal as well as the potential future rent growth, I know the last couple of years we've basically been flat. And I think that's helped with, we've had a lot of new inventory come online the last few years, but I think that should slow down. I don't think there's nearly as many starts. Again, I don't have the statistics in front of me like you and Spencer do, but I do think the lack of new deliveries that are coming down the pipeline, 26, 7, 28, should help, obviously, with occupancy as well as, most importantly, our abilities to start pushing rents again.
Right.
It's right now, one of the
Yeah.
big economic occupancy issues is
There you go.
we're working on renewals. The new leases that we have to, be competitive in the market is unfortunately below where we would like our effective market rent to be. Our current tenants are at it, and we want to renew and keep renewing them, and they can afford it. However, they go online and they see a unit being marketed for less or a unit down the street for less, and they almost want to lower their rent, which is not what the business we're in.
No.
So that's a difficult one, and as we continue to keep track of the economic occupancy KPI, it's interesting to always consider the trade out and what our loss to lease is, because that's different than a bad debt or physical vacancy and other issues. So hopefully we'll start to see rent growth come back to the market, and I think Indiana is very well positioned for that in the next few years, given we've had a pretty stagnant market the last few.
Yeah.
And I don't think anything's changing in the negative from people moving here, jobs. We have a very diversified workforce here in Indiana and in the Midwest in general. So I think we should be.
We released this 2026 Midwest Multifamily Forecast Report. Spencer, myself, and John Chapman. We published it back in January, and when we put that out there, Spencer was really bullish on the slower growth that we're seeing in the Midwest comparative to past years, especially in comparative to the rest of the nation, that while their growth was also slow in some markets, in regions, it was actually negative. And so we always talk about just the compounding of, slow, incremental, positive growth. And specifically when we released that report, Spencer was very excited about the slower growth means better entry points for acquisitions. And I think if you took a look at the data, like you just mentioned, and more of a broader scope, all of the fundamentals here in the Midwest point towards very steady, robust cash flow and potentially some significant upside on the back end as demand picks up, especially if we're getting into some of these A-class, new construction, new deliveries. It's just really hard to take a look at all the facts and the data and want to invest in Midwest or in multifamily anywhere besides the Midwest. I understand the South and the Sun Belt have got some really promising, demand trends, but they're also really saturated in supply, where the Midwest we're constricted and restrained in the supply. Even though we did see some healthy supply in the last 2 years, it's tapering off. We're seeing positive population growth. We're seeing wage growth, job growth. All the things point to Midwest multifamily. So if whether you're a Midwest multifamily investor, maybe you're an owner operator, you're an industry expert, or maybe you're just stopping by, we appreciate you listening to this episode of the Gray Report podcast. I'm Griffin Haddad, your co-host. I've got Matt, our asset manager, with us. We appreciate your ears, your eyes. We'll see you next week for another episode of the Gray Report podcast.